So this will be the second update video talking about my portfolio. This is certainly not meant to be investing advice, but I think it's educational for anyone to look at somebody else's portfolio and hear about their successes and maybe more importantly their failures and changes that they want to make. So this is the top 15 that I have. There's a few other smaller positions that wouldn't be talked about. I typically like to stay under 10% in as a max of any position, so I'm kind of breaking that with my top two right now. I actually added to some Tesla back near the lows. I debated between a call option contract, a long dated one to 2025 in the stock, and decided the better risk reward emphasis on risk side was to just pick up some of the common. And then I'm not ready to sort of get rid of my oil yet. I want to hang on to Whitecap. When I look at my portfolio, a large chunk of my dividend payers are sort of sitting in the middle. And this is something over time I want to work on increasing them in their weighting. That'll be something that I'll talk about. So as I did in the past, I'll go through sort of through the stocks in 5% chunks. Now, my goal of this portfolio is to turn it into the other portfolio that I manage for other people. So I'm going to quickly talk about that portfolio just so you can see what my vision and transition is. And it's been really interesting managing my money and this other pool at the same time with very different goals. So the other account that I manage, none of this is mine, is for people in retirement. Every stock in this portfolio has to pay a dividend and must raise its dividend every year or it will be cut and eliminated. So in this dividend portfolio, which again I want to turn my money into this over the next 15 years, I have a Canadian ETF, Canadian Dividend ETF. So about 20% of the money sits in this BMO account or BMO ETF. There's Emera, there's Telus, there's Enbridge, there's Brookfield Infrastructure Partners, Bell Canada. Was the old Brookfield Asset Management, now it's the management company, and Brookfield Corporation has been spun out. Whitecap is there. This has been a really nice balance in the portfolio, having a dividend paying oil company allowed this account to only be down 4% last year. Bank of Nova Scotia, Manulife, Toronto Dominion Bank, CN Rail, Algonquin Power, which is going to be fully cut because they cut their dividend, and Brookfield Reinsurance. This is the old ticker. I need to update the ticker. So all dividend payers. As you can see, I do intend over time to get rid of Bell Canada, Bank of Nova Scotia. I'm kind of tired of their underperformance, and Algonquin Power doesn't say a sell, but we'll go. Brookfield Reinsurance was just shares that were spun out, and I'll probably sell those at some point. So this portfolio currently yields around a little over 4%. So for every $1 million in a portfolio like this, it's going to pay out 40 grand annually. And that's what this account is meant to do, is pay out 100% of the dividends for people to live off. So all the dividends are transferred out monthly and none of the capital is ever spent. The overall plan in this account is to have a 4% dividend that is lived off plus anywhere between 2 to maybe 4% growth of the portfolio. What matters more is the growth of the dividends, and all the dividends in this account grow between 5 and a high of 10% a year. This portfolio was, I started managing it in 2020, and even through the COVID panic or crisis, it's performed really quite well. Again, Whitecap really helped last year, and that sort of balanced out the disaster that Algonquin Power has become. So sort of back onto mine, and again, you'll see this theme of transitioning my account to something like that. So the only thing I bought recently was I added 100 shares of Tesla at $1.23. So I didn't quite buy them at the low of about 108-ish. Again, debated between a 2025 call and the common, and when I ran a few scenarios and what ifs, I didn't want to take the risk with the call. I do already own a 2024, I think it's January, $300 call. I will soon have to start selling some Tesla just because of the waiting. So these 100 shares, if it does get back well over 200 or certainly into the high 200s, I'll have to sell some. Whitecap, just intending to hold and stay put. Constellation Software, I love this more and more. I've got the chart in the next slide. I got a whole video about Constellation Software. Hit a 52-week high. How many tech-ish companies have hit 52-week highs this year? Not many. And then I still have my Shopify and Lightspeed. I'll talk about those in sort of a couple upcoming slides. Don't want to go hardcore into Tesla. There's many other better videos or YouTubers than myself. But I was curious to go back and compare the price that I paid for my car 2 years ago to now. So, lots have been made out of the price cuts. So back in January, this would be 2021, I was lucky enough to be able to buy a Model Y. I'd saved up enough money, and it's really painful writing a check for that amount, but I paid about $69,000 for the car. This was a demo model, so I got a slight rebate because it was a demo. Because it was COVID, people had barely touched the car, and I liked that it was a demo. It meant you weren't going to have sort of the panel gaps and slight issues that Tesla might have had. So this is old. Currently, if you look up buying a Model Y, the current price is actually a bit more than I paid for it. So even though there's been these huge price cuts, it's just going back to what they were sort of start or early part of the pandemic. If you actually priced out the exact Model Y configuration that I have, it actually comes out to be $12,000 more than what I paid, largely due to the full self-driving increase. So anyway, my thoughts on Tesla is that the prices have to keep coming down, and I'm continuing to hold and add it a little bit. But again, I would be a seller in the future due to its waiting. Constellation Software, again, if I had to pick a boring favorite, it's Constellation Software. Only stock I can think of in the universe that's issued absolutely no shares over the last 5 to 10 years, and a 52-week high. Again, I've got a video on Constellation Software. I really analyze it year by year, not quarter by quarter. So probably every year I'll make an update to that video. But take a look at that one, and you just see this amazing, 20-ish% compounded growth the last while. If you do go back over the sort of life of Constellation Software, and this is from data from Canada Stock Channel, they have a nice compound calculator. If you go back to 2007, it's compounded 36% annually. Just sort of amazing. Boring company, rarely talked about. No conference calls. They say almost nothing. But their performance just really speaks for itself. So very little out there on Constellation Software. This is the same sort of slide I had about Shopify versus Lightspeed. Now these are my old numbers, so Shopify's really rallied, so that this is their price to sales, and so that's really shot up. Lightspeed would have only gone up a little bit. Again, these numbers are about a month old, so I like Lightspeed currently better than Shopify. I've added probably too much of both too early, so I'm not adding to any. Lightspeed's going to announce earnings in early February, Thursday, February 2nd. So I'm looking to see, can they sort of hold a 40% growth or not, or are they into the 30s? Shopify will be a bit later, February 15th, and they've been sort of dropping down into the 20% growth. So I'll be looking to see what happened, 16% last quarter. Now they did raise fees, I think 33% sort of across the board or something like that lately, and that caused the stock to jump. I'm more of a Shopify fan long term. If it can compound 20% for the next decade, that would be obviously amazing, but more like Lightspeed's valuation right now. But again, adding to neither, and on big price jumps, I would be selling some shares. I've sold bits of both of these in the past at much higher prices. Unfortunately, I only sold like 15% of what I had. Wish I'd sold more. And I've more than doubled my Lightspeed position on the way down. Again, bought too early. My next 6, I own a lot of the Brookfield pieces, so I definitely like Brookfield Infrastructure. That's one I want to hold as part of that all dividend portfolio in about 15 or 20 years when I'm retired. Same with TD. Crescent Point, I like having a little bit more oil right now, but over time I'll probably just keep Whitecap as long as they keep their dividend focus and balance sheet. And at some point I'll get rid of Crescent Point. Absolutely love Enbridge. We'll show their dividend in a second. And then Peak, I'm definitely a hold, wouldn't buy any unless I could get some through the prospectus, which I don't know if I will and want to aggressively try. But again, we're into the bulk of my mid part of my portfolio that has produces a lot of the yield. The current yield on my whole portfolio is about 2%. So I'm kind of about halfway to getting towards that 4% target. So diving into these a little bit more. First, Enbridge. I don't even look at the stock price daily. You want to have a lot of stocks that you just buy and look at occasionally that you really don't care. Oil isn't going away anytime soon. Pipelines, railroads are monopolies. It's brutal to buy a pipeline, to build a pipeline now. So I think this will be a great asset. And I think investors should really go and back look through the great financial crisis and see what companies did. So Enbridge has this 10% compound annual growth rate of their dividend. If you do go back through the financial crisis, so 7 to 8 to 9, their dividend still increased even through those obviously concerning financial times. And the same thing has happened through this current COVID financial time. So a nice, more than a nice, a very large dividend growth company. And if you keep growing your dividend 10% per year over a decade, your stock is probably going to follow along. And even if it doesn't, if your dividend keeps increasing, you're going to be fine, but you'll get the capital appreciation. So really love Enbridge, and it's something I just slowly add to each year. Tenet, so symbol PKK. So I have 2 sort of penny stocks, and I don't want to have much more than 3% in them. So I'm kind of tapped out on Peak and could add Doc, but don't want to. There's going to be a crazy amount of share dilution, even if things go well the next year. So they're hoping to do a prospectus and raise $30 million at $1 a share. The 30 million units would raise about 30 million, less fees, but the prospectus, each unit, if it was converted to common, would cause a dilution of about 30 million shares. The warrants, every warrant can get you a full share, so that could be another 30 million in shares. And if things go right, this is going to happen. If they go wrong, well, then we're all up the creek and we're going to lose most of our money. So if things go right, there's a 60 million share dilution just coming from this prospectus, and they have a current money raise that they did. So I figure share count is going to double if things go reasonably well over the next year. So we're really going to get sort of hit hard by that. But I'm just really curious to see how this Canadian expansion and US expansion and margins go. So I'm a holder of Peak, not a buyer, not a seller. But if it rallies strongly, like this is a company that was $5-10+ any type of $5+, I need to be a seller into strong growth or strong increase in share price. Onto my bottom 5. So Bank of Nova Scotia, I'm done with their underperformance. I bought them originally for their more Latin America focus, and I think I was just wrong with that focus. I don't think it was a good idea. So at some point into strength, probably when we're coming sort of out of this crisis over the next year and a half, I'll sell Bank of Nova Scotia, and I'm thinking about going into Royal Bank, is my thought. That is not their ticker, or I don't believe it is. The old Brookfield Asset Management is now Brookfield Corporation. Like that, haven't decided what I want to do with the new Brookfield Corporation versus BAM. Okay, I obviously have some shares in both. The investing account for other people has both, and I haven't fully decided if I'm going to keep both or just keep one. Doc, curious to see the next year if they grow at 10% or less. I'm done. I'd like to see them compounding some growth at 20%, which is not something that they've done. But we'll see what Karen Adams can do with the company. I like the focus she's had. It just at 10% growth, I don't think it's worth the risk for playing around in a small cap that's growing that small. So I'm curious to see. It's at a little under 2%. So then again, my 3% would be my penny stock cap. Algonquin Power, sold that in the other account that I manage for other people, and I'm going to be selling that. Yeah, it's not worth playing around with the Kentucky Power uncertainty, the dividend cut. There's just better places to allocate money. Telus, I owned this, sold it because I was too growth focused, bought some back, and I would like to grow Telus into my, 1 to 5 over time. Really like Telus, both for their, their phone assets, but there's so many other businesses that they're into that I think really sets them apart way better than Bell, and I like them better than Rogers. So yeah, that's one I definitely want to grow and increase over time. So kind of diving a little bit into those bottom three, I do currently own, again, 3 pieces of Brookfield. The Brookfield Infrastructure, definitely want to keep. And yeah, want to keep one or maybe both. There's a better YouTube video that I could make about the new transitions with Brookfield and their shares. So I'd recommend you watch that video, but this is one of the slides from their investor days, and they really lay out a nice growth thesis. And Brookfield's been a great growth story over the last few decades, or I guess a century if you want to go back long enough. But they strongly believe that they can grow the value of their business at 17% over the next 5 years, and they'll just buy back shares if the market doesn't reward them. But would recommend you take a look at Daniel's video on YouTube. I watched his whole thing and found it really informative, and so I'm not going to talk a lot about Brookfield other than to recommend his video and take a look at it. But Brookfield does intend to be one of those core positions, lower yield but nice growth. I'm slightly biased towards just keeping the parent Brookfield Corporation BN. I've had to resist owning the other pieces. I don't want to end up with all the little pieces and the corporate, the BN at the top. Last, or getting towards the end, Telus. Again, really love Telus, love their dividend growth. They're guiding towards annual dividend increases of 7 to 10%, which 7 is sort of, it's hard to get much better than that in dividend growth. And then their track record, I just love. So I kind of put Telus and think Enbridge are just great, stable parts of your portfolio. We could go into a horrible recession late 2023, and you really shouldn't worry about either of these. You should be wanting to pick up more, not have any concern. One thing I like about being an investor now is you can just go back 15 years, look at the great financial crisis, and sort of test some of these companies and see what they've done. So this is Telus's current dividend history. So if you go back to when their dividend was half as much, you go back 7-8 years and they only paid about half the dividend. I've cut out some years here, but I want to go back to the great financial crisis. If you look at 07 to sort of 09, their dividend increases still continued, no hesitation in that. So I see little reason for this to change in the future. You always have to watch companies in the future, but the previous track record, I think, strongly influences the future. That's always a disclaimer. The past performance, doesn't guarantee future success, but that's how the world works. We look at past performance. Every sports player gets their contract entirely on previous performance. It isn't perfect in both stocks and sports. So kind of where I'm at, my portfolio management plans, changes. I need to work on a little bit better focus. Every time things go well, we've good times, I get a little less focus. Too many positions take on too much risk. So I'd like to lower both the stock count and the risk. So I'm pretty dividend growth heavy and growth heavy, and want to get more dividend growth, not heavy, but slowly keep adding to that. So my portfolio is about 50% dividend growers, and I want to get to 100%. So no Tesla would be allowed unless it starts paying a dividend in about 15 years. So I'm not in a hurry, but I need to slowly start ticking that up. So on that theme of the better focus, I do want to trim. I have a little bit over 20 stocks or option contracts. So I'd like to get that down to 15. When you get downturns like we've had now, it's too hard to focus and sort of rally around and try to buy more of some of your favorites, or you can, but it's hard to be focused. I don't really want to deploy any capital right now. I'm only 7% cash, which is fairly low for me. I typically range between 5 and 30%. I haven't in the past bought bonds paying little to nothing. I've just always held cash. Maybe today there's a reason to not hold large amounts of cash and buy some bonds, but I always like having cash that you can deploy instantly anytime something falls. One of the few times I sold Tesla just happened to be the day before it fell. I think it was over 10%, and I bought it right back the next day. So I like having cash sitting there. So that's my portfolio and where I tend to move it over the next year or two. Not a lot of companies I really want to add, but I've been kind of watching CN Rail for years. I actually owned it for a bit and sold too much of my dividend stuff sort of pre-pandemic when I got too growth focused. Sold. I had some Bell Canada, some Telus, some Emera, some CNR, and kind of booted them all out. But I'd really like to add potentially CN Rail. It's just an amazing growth stock. Again, it's like Enbridge, but maybe a little bit more growthy in terms of pipelines, railroads. They're not going to be building more. And if you look at their growth over the last, since 96, so 30 years or so, they've compounded at 16-17%, including reinvested dividends. So it's hard to find companies that compound like this. When I was younger, even now, you sometimes try to find that company that's going to go up 20, 30, 40, 50, 100% in the next year. But money in the stock market is made by the things that grow 15, 20% for a decade or two. Is what make people fortunes. That's Apple didn't make people rich because one year it went up 1,000%. It's because what it's compounded over the long term. So this is one of the few things I'd consider adding. Post earnings, it has dropped a little bit, did raise its dividend. Right now, I'd sooner keep the cash because who knows what's going to happen in 2023. I certainly can't predict recession or not, so I'll keep the cash, but this would be one of the things I'd consider adding. So hopefully me going through my portfolio is some help to you with how you may want to restructure or manage yours. At the end, just encourage you to take a look at maybe my Constellation Software video or Daniel's Brookfield Assets Management / Brookfield Corporation video. Highly recommend those.